Dear participants, friends, ladies and gentlemen, we have had an elastic tea break. We intended to start earlier, but we weren't able to. Now you're back here. There are a couple of things we would like to mention. Your engagement, involvement, participation is invited. And not now necessarily, but during the course of our next session. And our session has a theme, and Dinasha will mention what the theme is in a moment. However, this is what you need to get in your system right now. We said your engagement is invited by way of WhatsApp messages or a message that you could send to the moderator. So the moderator will be on stage and he will receive your query, inquiry, your comment, brief of course, via this number on the screen. You get that number? I don't need to read out because all of you all have vision. Yes, so that's the number you need by way and through our official telecommunications partner. So that's where you submit your question or comment, a brief one. And that will be received on stage by the moderator. He will choose to the order in which those questions are addressed to the panelists. One more. We have an assessment partner, Pearson's, and here's a message from them.
We are born to learn. From our very first breath, we never stopped learning. It's our nature, our instinct to expand, to explore. Learning is more than just gaining knowledge. It's an action that starts a reaction, rippling through our lives, changing more than we realize. Proven to enrich our minds, enhance our health, revitalize our emotions, open doors, strengthen relationships, inspire purpose. Learning is vital to every aspect of our lives. To learn is to be truly alive.
And it says, do more and be more. And on that note, it was mentioned yesterday at the inaugural that management accountants now sit right at the intersection of data becoming decisions. And so it's very appropriate that this next session is called From Disclosure to Decision. It was also discussed that we can no longer ignore the cost to the common man, and the purpose is to make life better for us all. So where sustainability standards reshape corporate strategy and management accounting is going to be the premise of this next session, looking at how responsibility and investment appraisals, performance measurement, it's not a peripheral compliance exercise anymore, but it is sustainability itself is an active input into all of this. So with that, we invite on stage our chairman and panelists.
So the introduction will be by the chairman, Mr. Suresh Gunaratne. He's a fellow member of the Institute of Chartered Accountants of Sri Lanka and also of CMA and is an alumni of KPMG. He has a master's in business admin from the Postgraduate Institute of Management at the University of Sri Jawatanapura. And he's a member of the board of directors of Diesel and Motor Engineering PLC, DEMO, and serves as the chief financial officer. And he will be the first of those who address this audience. And you can start thinking about the questions that you would need to ask during that time. And we follow.
Our keynote speaker, Ms. Darshini Watawala, is a director at Deloitte Partners and a fellow member of both CMA Sri Lanka and CA Sri Lanka. Her master's degree is in financial economics from the University of Colombo. She holds over 25 years of diverse professional experience, and she has held leadership roles across financial and operational management, risk and compliance as well. She's been at the forefront of sustainability transformation and has led implementation engagements at Deloitte, as well as delivering training and capacity building programs on sustainability standards. She's made significant contributions to advancing integrated reporting in Sri Lanka and the region.
Professor Roshan Ajwad is a senior lecturer in the Department of Accounting, Faculty of Management, and his main areas of interest have been in corporate governance, auditing, ethics, and financial reporting. And he read for his PhD from the prestigious Waseda University of Japan. And he's a fellow member of CA Sri Lanka as well as CMA. And Professor Ajwad will serve as the moderator of this particular session. And so to the panelists.
The first of our panelists counts over 30 years working experience as a finance professional and is a founder director of She Consults Private Limited, a financial consulting company. She was an independent director on the boards of John Keel's PLC, Morrison's, and NDB Capital Holdings, where she chaired the respective audit committees. That's Ms. Aruni Rajakarya, council member of the Sri Lanka Institute of Directors.
Then also the Chief Financial Officer of SoftLogic Life Insurance PLC, Mr. Nuan Withanage, recognized as a seasoned finance professional with nearly 20 years of experience in the financial services industry, currently serves, as I said, the Chief Financial Officer of SoftLogic Life Insurance PLC. He has been recognized with the Best CFO Award and has been contributing to financial leadership and innovation in that organization as well as elsewhere.
Our next panelist, Dr. Noan Gunaratne, holds the position of Senior Lecturer in the Department of Accounting at the University of Sri Jayawardenepura, Sri Lanka. He is a fellow member of the Institute of Certified Management Accountants of Sri Lanka, CMA, and he earned his doctorate in Corporate Sustainability and Sustainability Accounting from Griffith University in Australia. Dr. Gunaratne has lent his expertise as a consultant on various projects encompassing education, waste management, climate change, circular economy, and sustainable agriculture.
And so to the other panelist, Mr. Nishanta Hevavitarna, Senior Vice President, Research and Strategy with the Colombo Stock Exchange. And his research focus has been in equity markets and behavioral finance. And he has a BSc in mathematics and statistics with an MBA in finance from the University of Colombo. And for the past 8 years, Nishanta Hevavitarna has been an active evaluator for the CMA Excellence in Integrated Reporting Awards as well. So that's the number of people who will be on stage. And we would like to invite them all to take their place, and I'll hand over proceedings to Professor Ajwad, but we kick off, as the saying has it, with Suresh.
Good morning, dear distinguished guests. First of all, let me thank CMA and Professor Waterwala for inviting me again. I think I've been in CMA forums many times, and I'm very proud about that. So today, I think I have to play a different role rather than being a speaker. When I look at the panel, I see a star-studded panel who have been actually in the forefront of sustainability reporting and also preparing sustainability reports. So today, my role is to set the playground or prepare the pitch for them to come up with a lot of ideas that they have on the topic for today. So I'll be very brief, maybe maximum 5 to 10 minutes, and then let us hear from the speakers and the panelists. So when you look at the topic today, starting from disclosure to decision, usually someone might say that it should be the other way. You make the decision and disclose it. But let's see whether that is what it should be. Let me start with the word strategy. Strategy, very often, is something that we hear in our organizations. And the moment we hear about that word, we tend to give a conceptual definition about strategy. It could be, this is how we will win in the market, or the manner in which we organize ourselves and our resources to achieve something, in a very conceptual way. But can we, by identifying strategy like that, can we do anything? I don't think so. We need to understand what is the material or what are the resources that we need to strategize. You take any strategic plan or strategy. Strategy can be present in various levels, at corporate level, at business level, maybe on the road, wherever. Any strategic plan will have to have resources. So what are these resources? I'm not talking about integrated reporting, but these resources are the capitals that we have. So a strategy to be successful, we need to understand how we organize ourselves. In other words, how we organize our resources. Because our strategy can be to win in the market, to compete, to differentiate, to diversify, to collaborate. It can be anything. But finally, we need to look at our capitals, our resources, to make it happen. It can be financial capital, it can be manufactured capital, it can be relationship capital, it can be in integrated reporting. I think we have looked at in detail. If you are not looking at your resources to do that, I think we have not understood it properly. So, now I just spoke about 6 capitals. So look at who provides us with those capitals. All capitals come from our stakeholders, isn't it so? Financial capital, relationship capital, human capital, whatever. There is a stakeholder involved. Except for manufactured capital, which is usually derived from either human capital or financial capital. And I include natural capital also as a stakeholder, because although we may tend to think that natural capital is not a living thing, it is. The only difference is there is no two-way communication between the stakeholder and the company when it comes to natural capital. But there is one-way communication also. The nature does a lot of things. Nature communicates with us in a lot of ways, but quite a few of them we don't like storms, temperature rising, floods, because when we make a change to the nature, nature will adjust. It's us who will not like the way the nature adjusts. Right. So when we are talking of stakeholders, what comes to your mind first? Sustainability. I think when we learned about sustainability first, it's the first thing that we did was we looked at what are our stakeholders, who are our stakeholders, and what are the material issues that the stakeholders have, and what impact can we have. Going forward, now with the advent of S1 and S2, we are now talking about something called double materiality. There is no magic about it. So that refers to, very simply, the activities of the company that can have an impact on others, which is usually called impact materiality. You can use any word we like. So by that, what happens? We impact our stakeholders. So whether they like us or not will, to a large extent, depend on how we impact them. It can come by way of a relationship, by way of how we treat the nature, customer experience, the waste disposal. It can come in many ways. On the other hand, that is called inside out. That means what we do, how is the outside impacted. Then we have outside in. That is how the company gets affected when things happen outside. Say something like what is happening with the war. Now we are getting affected. Or weather. Now we are in agriculture business. The weather has a lot to do with our business. Tractors, fertilizers, and so on. And every business will have its own implications. So when we recognize this, that sustainability involves stakeholders, and when we recognize that stakeholders are a major part of our strategy, actually it's what the stakeholders give us that we use for the strategy, I think there is a very clear nexus between sustainability and strategy. Now let's look at sustainability reporting, because I think that is what we are supposed to talk about today, and also the role of management accounting. So as far as sustainability reporting goes, what S1 and S2 did, the main thing that S1 and S2 did was to bring up a structure and a universal standard to report about sustainability. Earlier, it was voluntary. Earlier, a company's thinking was, when you look at inside out, we have to manage our impacts on others and make a good name. That will help us to build our brand name, brand equity, and that will help us to build relationship or damage relationships. On the other hand, outside in, we wanted to make sure that we have a free flow of capitals from our stakeholders. But now, with S1 and S2, they want us to go take a step ahead and see what are the financial implications. As a person propagating integrated reporting, I believe, this is my personal belief, that these standards not only should consider financial impacts. As we all know, the S1 and S2 is more bent on the impacts, sustainability-related risks and opportunities that can impact a company in the short, medium, and long term. The impact means, what they mean by impact is the ability to raise capital and ability to create value in the short, medium, and long term. So, sustainability standards actually drive the stakeholder relationships because it has given a clear structure. I'm not saying mere sustainability reporting will drive strategy, but the basis for formalizing the groundwork required for strategizing, that is managing capitals, all 6 capitals, is there in the sustainability framework. Just one more thing before I conclude. about the role of management accounting in this whole equation. Now, we all know financial accounting is about reporting and maybe treasury, if one says so. Now, financial accounting in my company, we rolled out SAP, and there is a module which will give us the consolidated accounts. So what is going to be the role of the financial accountant? Yes, there is going to be. It's not that it is not going to be. The journal entry has to be passed by the financial accountant. That also might be overtaken. You never know. But when it comes to the management accountant, the programmability of, or through AI or whatever, the programmability is less because there is a lot of discretionary decisions involved. Now, a management accountant, in a way, I would call a management accountant as the telescope of the organization or the microscope of the organization, who sees what's going to happen in future, what is happening at the moment. Interpreter, alarm, you can call it anything. So, for the management accountant, again, the basis for planning is your capitals or the resources. So, as companies, what do we have to do? I'm going to refer to a couple of articles that I read. One was published last year, both HBR. One, what was published last year said, companies have to rewrite their narrative on sustainability. They need to, because they are not very clear about why they embrace sustainability or why they do sustainability reporting. So the purpose has to be understood, the role of sustainability has to be understood, and what is material has to be understood as a company. Now, for that to happen, your strategies and everything has to be based on sustainability related matters vis-a-vis stakeholders. The second message that gave was, which I think we should take seriously, not by anybody else. It was Professor Robert G. Eccles. I think if you have read something about integrated reporting or sustainability, famous name, HBR professor, Said School, Oxford and all that. He has been writing very frequently. He has done a research with ExxonMobil, and he has come up with a research article which was published on the 14th of this month on HBR. He says that he has done a research at ExxonMobil and that he has been able to, using AI, he has used 4 LLMs, long learning modules, that is like ChatGPT, 4 LLMs, to establish a relationship between sustainability and the financial impact. Of course, again, I must say, it's not only financial impact that we should measure, because brand equity enhancement doesn't have a place in sustainability, which I think should be. So we need to first understand why we have embraced sustainability, why we report something. And then again, we need to be up to date with technology going forward. So without taking more of your time, I think there are some distinguished speakers. I hope I have said the tone for today's discussion. Thank you very much.
Indeed, Mr. Suresh, thank you very much for your insightful remarks, opening remarks. Indeed, it comes from a person who gave the leadership when it comes to integrated thinking. And you are one of the thought leaders who instigated the interest of integrated reporting in Sri Lanka. So thank you very much for shedding light. We really like that how you remarked about strategy and the resource fit. So that's a very important point, because we might have a strategy, but if we don't have the resources, that's not going to work. So you remarked that there is going to be 6 capitals and how it could be integrated into the strategy and then achieve the strategic initiatives. I think that's a very important point, as well as how you explain that not only financial resources, there are other 5 capitals that you have to look into. So Thank you very much. And of course, you also explained not only the financial impact, we have to look at the impact and outcomes, output of other areas as well. And particularly, it reminds me about the balance scorecard, where we can expand the balance scorecard framework to capture these aspects. Thank you. Thank you very much for the insightful remarks.
Thank you, Professor.
Now, we shall go into the next agenda item. That's to have a keynote speech. I would like to invite Ms. Darshini Vatawala, Director, Deloitte, to deliver the keynote speech for this session. Please.
Good morning, everyone. CMA President, Professor Lakshman Vatawala, Vice President, Council members, distinguished guests, ladies and gentlemen. I'm delighted to be here today to talk about sustainability standards and how they are reshaping corporate strategy and management accounting. And I thank you for inviting me to do so. Over the past year or year and a half, we have been talking a lot about SLFRS S1 and S2. And especially if you are a company which falls in the top 100 listed companies in the Colombo Stock Exchange, you would have been focused on understanding and implementing SLFRS S1 and S2. Much of the conversation has centered on disclosure requirements. Today, I would like to explore a different perspective. What if the greatest value of sustainability reporting is not the report itself, but the decisions it helps us to make? That is what I would like to discuss with you today, from disclosure to decision. As Mr. Suresh Gunaratna also mentioned, generally we would think it should be from decision to disclosure rather than disclosure to decision. But I think we can look at it both ways. There are some companies for which decision is at the forefront. And because of the decisions they make on sustainability, reporting itself becomes secondary. But there are other companies for which perhaps sustainability may not have been at the forefront, maybe because their stakeholders have not really asked for it, right? And due to the sustainability standards becoming mandatory this year, they have been forced to look into this. And by doing so, they will be actually forced to look at these sustainability considerations, and perhaps that will make them consider a disclosure, and from disclosure to come into decisions. So as I mentioned, companies have spent a lot of time discussing compliance and disclosure requirements. These are very important things. But management accountants also have a different mandate. Our role is not just reporting information. Our role is to convert this information into decisions. So today, let's look at sustainability through the lens of crisis, stability, and growth, which is very fitting considering Sri Lanka's recent journey through an economic crisis. The Sri Lankan crisis gave us a comprehensive lesson in understanding enterprise risk. Many of the risks that caused real business disruption never appeared in our traditional financial statements. Energy insecurity, forex shortages, supply chain disruptions, governance issues, talent migration. Yet every one of these eventually became a financial issue. That is why sustainability matters. It helps us to identify drivers of future financial performance before they appear in the financial statements. So let's look at the evolution of sustainability reporting. Mr. Suresh Gunaratna also touched on this. So we started with voluntary disclosures, perhaps as a CSR report in our annual report. And also there were certain standards available, but because of the voluntary nature, people had the flexibility to pick and choose, and that also limited comparability. So as you would all know, with SLFRS S1 and S2 becoming mandatory for the top 100 companies listed in the Colombo Stock Exchange for financial years starting from 1st January 2025, sustainability reporting has become more structured. And also there are growing regulatory requirements around the globe, especially from Europe, that may impact certain Sri Lankan companies as well. So let's look at what we can expect in the future. Sustainability data is now becoming part of management decision-making. The real transformation is not just better reporting, it's about better decisions. This slide shows the journey. So we start with the standards which generate data, because standards require you to disclose certain information, and for this information we require data, and data generates insights. And these insights basically are what we require to support management decisions, and decisions are what creates value. So the question for management accountants is simple. How do we ensure sustainability information reaches the boardroom and influence choices? So here are some of the stakeholders that use the sustainability information. This is not in relation to any of the standards, because certain standards and some of the standards are geared towards different stakeholders. So these are some of the stakeholders I thought as important. So you can see we have all these different stakeholders, investors and lenders who allocate capital, customers give us business, regulators create accountability, and preparers. They generate trusted information that we can rely on, and management allocates resources. The real challenge here becomes ensuring that information serves all of these stakeholders while still supporting better decision making. Let's look at a management accountant's perspective. Traditionally, we may have asked, how much have we spent on sustainability? Today, we should ask, how much value did sustainability create? Did it improve our margins? Did it reduce risk? Did it secure customers? Did it attract capital? That shift in thinking is where management accounting becomes critical. So let's look at an example from Sri Lanka's export manufacturing sector. Haley's Fabric PLC provides an excellent illustration of how sustainability is moving beyond reporting into strategic decision-making. As a textile manufacturer, Haley's Fabric has to work with many global brands. When global brands choose suppliers today, they still look at price, quality, and delivery, but they're increasingly looking at other metrics as well. They're looking at carbon data, resource efficiency related to water, energy, waste, labor standards, and traceability. That means sustainability is no longer just a reporting issue. It is becoming a market access issue. The question is no longer, can we report sustainability? The question is, can we remain part of global supply chains? In their annual report, Haley's Fabric discloses innovation, sustainability, renewable energy, etc. So some of these disclosures I have here. So they are saying group-wide renewable energy usage currently stands at 72%. 88% of their suppliers are subject to social and environmental screening. and they have ongoing waste reduction initiatives. And the group's energy efficiency program includes energy audits, energy efficient equipment, etc. And they have also mentioned that their energy consumption was reduced by 224,000 compared to the previous financial year through fuel optimization and energy efficiency initiatives. They also have innovation initiatives which support their customers' sustainability objectives. So what interests me here is not just the disclosure. What interests me are the decisions behind the disclosures. Renewable energy investments, supplier screening, production innovation, waste reduction. These are management decisions. The sustainability report tells us what happened. Management accounting helps explain why those decisions make business sense. So this is another example. So this slide illustrates the disclosure to decision journey. Energy data by itself has limited use, right? So we have seen now here, Haley's Fabric has disclosed different types of energy that they use. And also they have given their energy intensity ratios. So this is more what is required by the GRI standards. And then we also have at the bottom certain risks that they have identified, such as disruption to energy sources. So this would be a disclosure that is required by SLFR standards on risk and opportunities that the company faces. So under SLFRS S2, we begin to basically understand energy-related risks and opportunities. Management can then ask, should we invest? Should we improve efficiency? Should we diversify our energy sources? So the result can be lower costs, protected margins, and greater competitiveness. This is how sustainability can become strategic. Haley's Fabric has innovative projects such as the Evolve, the art of transformation, which highlights their upcycling and circularity initiatives. Traditionally, waste was considered a cost. Dispose of it, and then you can just move on. Today, waste increasingly represents an opportunity. You can recover materials from your waste. You can be innovative about it and come up with new products which can produce additional revenue streams. So that is why sustainability is increasingly connected to business model innovation rather than simply environmental performance. So now let us shift from export manufacturing to hospitality. The principles remain the same, but the sustainability drivers are what is different. So when we think about successful hotels, such as John Keel's hotels, we often think about occupancy and revenue. But these outcomes are driven by deeper factors: energy efficiency, water security, talent, community relationships, and climate resilience. What sustainability standards help us do is recognize these as business drivers rather than just externalities. Let's look at what determines hotel profitability. So traditionally, we would have looked at metrics such as occupancy, average daily rate, or revenue. So traditional metrics tell us basically how we have performed. Now we look at newer metrics, which help us explain how we performed the way we did. For example, energy efficiency affects operating costs. Water stewardship affects both cost and operational continuity. People and talent affect service quality and guest satisfaction. Community relationships influence reputation and the license to operate. And climate resilience affects long-term viability of tourism assets. Every sustainability KPI eventually becomes a financial KPI. So John Keel's Hotels reports metrics such as energy, water, and carbon footprint and intensity, right? Carbon footprint per guest night, right? So management accountants basically have to create the connection shown on this slide. So for example, energy per guest nights becomes the cost per room. And the cost per room influences margins. And margins drive enterprise value. This is how a sustainability metric becomes a financial metric. So now let me turn to climate resilience, which is often misunderstood as purely an environmental concern. I would suggest that for most boards and CFOs, climate resilience should be viewed as an asset management issue. So let's consider John Keel's hotels within the hospitality sector. Hotels are long-term assets. They are built with investment horizons measured not in quarters, but in decades. When John Keels makes investment decisions today, the question is not simply whether a hotel will be profitable next year. The question is whether that asset will remain competitive, resilient, and valuable 10, 20, 30 years down the line. This is where sustainability standards are fundamentally changing the conversation. Historically, climate-related information may have appeared in a sustainability report. Under SLFRS S2, climate-related risks and opportunities are increasingly being connected to enterprise value. Management is therefore required to think about questions such as, how vulnerable are our assets to extreme weather events? How dependent are we on water availability? How exposed are we to energy price volatility? What investments today can reduce future risks and costs? So these are no longer just environmental questions. These are capital allocation questions and strategic planning questions. And importantly, they are management accounting questions. For example, investing in resource efficiency may increase capital expenditure today, but it can reduce operating costs, enhance resilience, and improve long-term returns. Likewise, investments in climate adaptation may not generate immediate revenue, but they can protect future cash flows and safeguard asset value. This is why climate-related information is moving from the sustainability function into the boardroom. The role of management accounting is to translate climate risks and opportunities into financial implications that support better decision-making. In short, climate resilience is not about protecting the environment alone, it is about protecting the long-term value of the business. The Sri Lankan crisis also highlighted another important sustainability issue: people. Talent migration affected every sector. So what is often reported as an HR metric is actually a business metric. Employee retention affects productivity, and productivity affects quality, and quality in turn affects customer experience, which affects profitability. Human capital, therefore, is a value creation issue. So let's look at what a management dashboard can look like in the future. Organizations that will succeed in the future will have a broader management dashboard, a dashboard that includes energy intensity, resource efficiency, talent retention, supply chain resilience, and climate exposure alongside traditional financial measures. Why? because these metrics often act as leading indicators of future financial performance. Financial reporting tells us what happened. Sustainability information increasingly tells us what can happen next. And that is where management accountants can create significant value. The role of the management accounting is evolving from measuring performance to helping organizations anticipate future performance. This slide basically captures the essence of today's discussion. At the bottom, we have disclosure. This is where GRI and sustainability reporting traditionally began. The next level is insight. This is where the SLFRS standards are making an important contribution by helping organizations understand sustainability risks and opportunities that affect enterprise value. But insight alone does not create value. Value is created when insight leads to better decisions. And decisions about investments, resource allocation, product development, people. These decisions strengthen resilience, and this leads to growth. This is especially relevant to Sri Lanka as we continue our journey from crisis towards stability and growth. Better information will be important, but better decisions will be essential. I believe the conversation in boardrooms also will be changing. Historically, boards might have asked, do we have a sustainability report? Today, they might be asking, what sustainability risks threaten our business model? How will they affect our financial performance? Are they influencing investment decisions? And how do we measure resilience? And where can we create sustainability value? I would like to conclude with one final thought. The most successful organization in the coming decade may not be those with the most sophisticated sustainability reports. They may not be even those with the largest sustainability teams. They will be the organizations that use sustainability information most effectively to make decisions. Thank you.
Thank you very much, Ms. Darshani, for a very insightful and very resourceful keynote speech. And she indeed well elaborated the connection between disclosure and decisions. She linked between that better decisions lead to better information, better disclosures leads to better decisions. And there she highlighted the management accountant's role. Our organizations exist for one reason. Yesterday, I heard it from Professor Watawala as well. One reason. You might say value creation and other kind of things, or maybe kind of wealth maximization, that kind of things. But what he explained, as well as what I would like to emphasize accordingly, is we exist for one reason. That's for value creation. If we can't create value for the society, we get extinct. That's the formula. So we have to ask ourselves, what's our unique value proposition? What are we trying to give to the society? So yesterday, Dr. Sugit was asking, why do we have this conference? Why professional bodies like CMA has this conference? The very reason to give that value, to create value, to help you create value. So Ms. Darshani's speech encapsulated and highlighted that fact very well and indicated in that value creation process, what's the management accountant's role? Earlier, management accountants and the accountants were treated as value reporters. They just reported things as it is. But now, we play a co-pilot's role. We create value together for the organizations. We create value. So that's the very valuable, insightful comment as well as the insights that we could get. Thank you, Ms. Darshani, for highlighting that very important role of management accountants, and it's really appreciated. Right. With that, we shall now move into our panel discussion. So I'll be serving as the moderator, and my fellow panelists were introduced, as well as the chairman, Mr. Suresh, as well as Ms. Darshani. Also, I'm going to get involved in our deliberations. So to start with, so we are going to actually, based on the time frame that we have got, we are going to have 2 rounds of discussion if possible. The first round will be looking at what are the current practices. What are the current practices when it comes to sustainability disclosures? Then we also will be looking at what are the future insights, the future trends that we could see in terms of sustainability disclosure as well as decision-making processes. So to start with the first round, we'll start with Mr. Suresh Gunaratna, the chairperson, just to have some small insight on. Right, now we did understand in the keynote speech as well as in our deliberations that, as you also explained very well, we need to link strategy with sustainability. But however, linking that is sometimes not that easy, because strategy is made at the echelons, top echelons of a company. But however, getting the top management support might be a little bit challenging in terms of sustainability, unless it's mandated. Although as management accountants, we would understand the importance, but sometimes the top management might have other priorities. So how you could convince the top management, unless it's a mandatory kind of a requirement, then you have to do that. How would you convince them? Or how did you convince them and became so successful in your journey?
Thank you, Professor. So, I know it's a very prevalent situation now. If whether somebody should go and preach sustainability to a leader, I don't know whether that it works that way. I think what you need to make people aware is the commercial side of sustainability. Very often we tend to put forward arguments or reasoning that are associated with our responsibility. I think when you are now, our shareholders, for example, put money, very often I say this, in a company to get a return. Not to be, not to look after the world. Because like Friedman said, it's up to the governments to look after the country. So we need to figure out how this investment will lead to a return. Now, the basic problem that we have in pursuit of this is very often leaders are remunerated on short-term results. Now, sustainability or something definitely is medium and long term. So, I mean, okay, you can have a business, hard stop on business if you do something very, really bad, like emissions or polluting or something. But usually investments in sustainability are medium and long term. So, it's very important that somebody drives home to the leadership in that manner. For example, you can look at risks like this, which is, I think, for the standard as well. Now, you have your basic business model. No? You have stakeholders, they provide capitals, capitals give inputs, you have a process, then you have output and outcome. You have that model. No? That model will have to work in any company, whatever business you are in. But leadership understands the importance of all these people. They know about how importance of stakeholders. They know about the capitals that are required. They know about how good the processes have to be, the output quality, the quantum and the quality of outputs, the outcomes. We have to be very careful. Leadership knows about it. But the thing is, it's not done in a structured way. So, first realization that the leadership should be given is that This is sustainability is not about responsibility, it's about a return. That message has to go. Now, I know it's very hard now. Say, if you take an example, if you go and talk to somebody on the lines of, say, a CEO or somebody might say, customer retention is a problem. So, is this sustainability thinking going to solve that problem? Right? So, what you need to then explain is inside out, outside in. Is this person leaving because of outside factor or whether we do something wrong? Right? Then that person will don't talk theory. But I would say, so if you want to know about the answer to this, yes, please go back to the theory. Is this person going because of something happening outside or whether something happening inside? So that's, it's a realization. So, I mean, the short answer to what you said is, I don't think you can go and preach. People have to understand the value. How you can make them understand is, one thing is to say that we should not be looking at short term only. Second is look at the risks of your value chain. And the remuneration also has to address that. I think remuneration getting addressed now is becoming more and more prevalent. It's a matter of time that it will trickle down to everyone. So other than that, preaching about sustainability, I don't think will do a trick.
Thank you very much. Preaching wouldn't do, and you have to show the value for the organization. Particularly, Mr. Suresh answer included the long-term value, not the short-term. The short-term, sometimes there might not be that much of value, but when it comes to the long-term, of course, it will preserve the organization and even enhance the value of the organization. So you have to show that to the top management. Maybe tomorrow, if you are going to go and convince your top management, I think that's a good strategy to use. Thank you, Mr. Suresh. And now let's turn into our panelists. So the first panelist is Ms. Aruni Rajakarya. Thank you very much. Representing several echelons, top echelons in the boardrooms, like including the Institute of Directors, a council member, as well as representing several audit committees. So, Ms. Rajakarya, so let me turn to you. So what we see is sometimes that certain organizations, certain companies, they look at the sustainable reporting or sustainability activities as just compliance. So they don't go beyond compliance and they think that yes, it's a compliance exercise. What do you think about that, and what could we do to overcome that kind of a box ticking compliance approach?
Okay. First of all, thank you to CMA for having me as a panelist at this wonderful conference. So I think first thing that board members do is, must do, is get training on sustainability, what it means today. Because there have been so many versions of sustainability floating over the last 20, 30 years, it means different things to different people. So as a boardroom, they must come to one understanding, one definition of what sustainability is, and they need to get their legal responsibilities well understood. So I would strongly recommend, with SLFRS S1 and S2 becoming mandatory, that directors really understand their legal responsibilities and the role that they have to play. So the Institute of Directors, together with the stock exchange, have put together a series of smaller workshops, 2-hour kind of thing, where we give some training. But, whether it's through that or through some other initiative, it is vital that you do that, so that you understand concepts like, you have to have your governance in place. It must relate to strategy, risk, metrics, as Suresh spoke about, the short, medium, long-term lens, the aspects like, sensitivity analysis and scenario analysis that's required. What are the factors that you need? Beyond training, I'd like to take it into 4 parts. Understand your value chain and impact assessments, responsible resource allocation, which Suresh and Darshini both touched on, and then effective governance and oversight. So I'm going to come to that last. So let me just go through what I mean by this. Understanding your value chain is vital. You have to understand, let's take a bank. Is it depositors coming to the bank to deposit the money and then you lend it out? Is that your value chain? No. It is whether your bank is predominantly exposed to farmers, fishermen, where are your customers getting their money from? And where is your money ending up? So that whole thing, right? Typically, every value chain starts with a natural resource, which is extracted, transformed, transported, packaged, and sold to a consumer. If you take this bottle of water, and let's say you paid 250 rupees for this bottle of water or 200 rupees, all that money has gone into everything other than water. Water has been free because nature gave that to us. Oil, the electricity that comes into our home, so oil in the process. Oil is free. It's what we pay for is the extraction and transformation and transportation. So if boardrooms understand their value chains, better decisions will be made because you will have better information, whether it's external or your own consumption, you will have better information. You will ask for better information. Your questions will be more insightful. The next one is impact assessment. So external stakeholders, internal stakeholders, as Suresh mentioned, if your customers are unhappy, board members need to know that. In the end, what is corporate governance? Balancing your stakeholder interests. So the money, the distribution of value created, how you create value, and the distribution of that value. Those are decisions that are made in the boardroom. So if you know the impacts, you will see changes. So it was really interesting during the pandemic to see how boards quickly responded to stakeholder needs. Companies that were, say, retailers, national retailers, national level companies, they took care of both maybe the farmers who were supplying products to them for processing. They were given advances and kept afloat. The distributors were given support. The larger player in the value chain facilitated this, right? Post the economic crisis, we saw value shifting, the value distribution shifting more towards employees. And in some cases, many cases, the investors took that hit. And boards made some very smart decisions. I don't know whether they were smart enough to retain the people, but they did make some smart decisions to keep the stakeholders engaged and the businesses sustainable and resilient. So they built some resilient value chains. So that's an example of how board members monitored and took action. What did they do there? The third point, responsible resource allocation. There is a finite pot of money. There's a finite card. You can't have all the employees and be irresponsible. Fortunately or unfortunately, the Sri Lankan labor laws don't let you dismiss employees. Otherwise, we may be seeing the kind of layoffs that the tech industry is going through globally. We are not seeing that because there is a payment that needs to be made if you're dismissing somebody, or you have to go through the legal process. So Sri Lankan employers are typically cautious about hiring. So we don't have crazy human resource budget. So everything is a finite resource. No resource is unlimited. So how do you manage those resources? And it's really important to kind of see some things. Everything has a good, every innovation has a good and a bad side, right? Take AI, for example. It can make blind people be aware of their surroundings better. The meta glasses, for example, can be used to help blind people, see who came into the room. It can communicate these things. Are they smiling? What's the mood in the room? All these things. You can use it for the good. But it can equally be used for irresponsible things. Take social media. Facebook was set up to connect people, and it was great. Today, we're talking about using that data for anything from marketing, which may be acceptable, but the next stage may be surveillance pricing. Now, are you okay with that? Right? So anything can be used for the good or the bad. And that's where directors need to be very clear about what they're allocating resources to. And here it's worth noting how cost behaviors are changing. Earlier, I don't know, maybe 20 years ago, if you wanted to buy Microsoft Office, you had to purchase a CD, right? And it would sit in your laptop maybe 4 years or 5 years or whatever. Then from there, it went to subscription. So today we are comfortable with a subscription-based model. Now it has shifted from intangible assets on your balance sheet to OPEX. Right now it's an expense. From there, today AI is looking at tokenizing. Right? How are we going to manage? We're going to need metrics, human metrics, right? So in this whole responsible allocation of resources, it's really vital that you understand how cost pricing, value extraction is changed. So that's one there. All of this comes to effective oversight and governance, having proper board structures, policy frameworks, systems, metrics, risk management systems, and making sure that people are aware of. The other thing that boards must do, and particularly I would say AI is one area, where you talk about responsible or deliberate about guidance that is required now. Legislation or regulation typically comes too late. If you are proactive, you will be making decisions well ahead of regulation, right? So AI is an example. Today, Meta is in the market. They can sell you WhatsApp data, for example, for your marketing campaigns and so on, and you may be comfortable with that. Are boards going to be setting boundaries and saying we are not going into surveillance pricing? If that is on offer, I'm not sure whether it is, but these are things that boards have to proactively think about before it becomes a problem. So future guidance to be given to management as to how any technology, any innovation is deployed and used, right? So you can use the same thing for good for bad or for just, being relevant. And the boards should be giving directions to minimize negatives, enhance positives, and to ensure that you're relevant to the progress of society and the conservation and rejuvenation of the planet. Let me leave with that.
Yes, thank you very much for that elaborate answer. And I really liked what you told about training and awareness. So, because with that only we could understand, the directors could understand to go beyond just box ticking approach and a compliance approach, but to understand their true responsibility. Their kind of responsibility towards the stakeholders, not just the shareholders or themselves, but regarding the stakeholders. And you also told that certain institutions like the Directorate Institute as well as the stock market are involved in giving that training. And so that kind of awareness will be really helpful. I think we as management accounting profession, CMA, also could partner with that kind of initiative where we can provide the necessary management accounting insights into the directors. So I would like to also suggest that to Professor Watavala and the council to think of how we can partner with the initiatives where we can get involved in director training. So because that will be, so we can provide programs and others. I think that will give some insights to them to navigate as well as discharge their responsibilities properly. Thank you very much. So now let's move into Mr. Nuwan Vitanage from Soft Logic Finance. So he's a well-performing as well as a CFO who had got accolades. So we are very happy to have you on our panel. So Mr. Nuwan, what I would like you to now, of course, as CFOs, as accountants, we produce a lot of information, sustainability information. And S1, S2 are guiding us. That's correct. But the problem is, do investors really use it? Is there an impact? What do you think?
So, first of all, I must thank CMA and Professor Vatavela for inviting me on this to speak something I really like. Coming back to your question, Professor, I think my answer is yes. For foreign investors, I'm telling from my practical experience. So, however, still for when it comes to local investors, that consideration is still limited. So, but I would like to plant something to the audience here. So, we discuss a lot of areas about sustainability. So, what I think is that why this came into the, especially IFRS S1 and S2. So back then, investors took the decisions by looking at traditional financial statements. Now, so investors invest in certain companies looking for future, not their consideration given on the past information is very limited. So why I say that, let's look at the company, you might have thundering profits today, but there's no assurance given in the financial statement whether your business model, in the other way I used to say, money making machine is strength or not. For me, sustainability is like medical checkup. So we do medical checkup to ensure all the parts of the body is running well. So are there any issues or something like that? Find out that. So sustainability is something that to check whether your money making machine or otherwise value creation machine or otherwise business model, whether functioning well. So they introduce a lot of checkups. So why that brought is that in nowadays, today you might have very strong business model, but factors arising from environment or governance or technology tomorrow your business model become a complete obsolete. So therefore, when the investors, especially foreign investors, needs to look at what is the governance structure we place to ensure how we strengthen our business model, because that's the foundation to ensure that how well we create value for tomorrow and day after tomorrow. That's one part. And there's another part is available, that is impact investments. So nowadays, especially foreign investors, they look at impact we created to community, and they don't look at only for disclosures, they want to measure it. And so now we discuss here whether sustainability is an agenda item or not. So, and I would say director's perspective, and yes, they can show good profits in the P&L, but their bigger responsibility is that to maintain healthy engine, to ensure that tomorrow and day after tomorrow, their company will be generating value. So what are the matrices is depends on your business model. For example, that I can tell from my experience. So we are in the business of life and health insurance. We are taking customer for long term. Like today we take, today we price our customer for 20 years, long journey. So we are the company, we need to forecast future mobility and mortality rates, let's say 20 years future, and today we need to price and give it to the customer. It's a long-term relationship, right? So for me, sustainability is big, because today I can make a profit in the P&L, but by doing the wrong pricing, compromising the long-term mobility and mortality to attract the customer and showing the profit today. But if we don't have the right matrices to ensure that whether my pricing is done correctly, tomorrow my cash flows become negative. I might record in the negative profitability. So that's why we need to have that certain check and balance to ensure whether my money making machine is up and running, to ensure whether I can make a profit for tomorrow and day after tomorrow. That's why I said, for me, sustainability is something like medical checkup. So, and obviously, foreign investor or any investor don't want to invest money for any company if they don't have these checkups, because it's a profit is something past. But if you have right check and balance to ensure that your business model or money making machine is running up and running is very well. So that's a guarantee to ensure that tomorrow and day after tomorrow value creation is protected. So in our business, we do two measurements, like obviously you see the P&L, you see the profits. And there's another check is happening. So you can now check and balance to ensure your profit is or pricing is correct, so on and so forth. End of the day, we do and ensure that our long-term value, we measure something called embedded value, right? So that ensure that, okay, long-term pricing and based on the best estimate results, what is the value being created beyond the profitability? So if you have right checkups, one thing, you might have the current profitability higher. Apart from that, it shows that what is the value we created, investor angle, beyond the profitability. So I think there's no question that directors taking sustainability serious matter or not. It's all about understanding what this is. This is the test of your business model to ensure that future is guaranteed. No investor wants to invest some company which future is not guaranteed, that money making machine is not evaluated and tested, and controls are not placed. So that's a fundamental thing from investor angle. So apart from that, now is a foreign investor, especially I deal with the development funds. I deal with the 3 development funds last 10 years. So their story is about impact investments. So they talk about profit with purpose now. And it's all about identifying and quantifying the impact. So you can have the profits. And because something I can tell you that impact also nowadays people take, okay, you can have the impacts, but they are not material, not a significant, then become it's more annexure kind of thing rather than boardroom agenda. So we might have a different business model. It's our responsibility to identify material impact indicators. So, and I can share my experience. Like, I don't know whether you realize in Sri Lanka, on average, every citizen is losing, on average terms, 100 days per year due to illness or premature death. It's a shocking news. It's shocking news. This is a study, independent study run by UK independent firm. We measured it. And why we did that one, because that party was introduced by one of the development fund. Because we are in the business of life and health, we want to understand how we can create impact on that. So they further went at, that's concept called disability adjusted life year. So that's measure the unhealthy days of the life. And that study further revealed that, okay, what ailment contribute for that. So why we identified that we want to ensure from our insurance cover whether we are giving right covers to our customers. So they evaluated our covers and ailment and they matched and say that 80% of ailments we are capturing. That means we are giving right covers to customers. So then they have evaluated from our customer base. We cover 1.5 million customers in Sri Lanka today. And last year, they calculated and say, what is the relief we have given to the public health care because of our insurance cover? Because if we don't have this insurance cover, these are the customers they are giving, and they have to use the public healthcare. So they quantified saying that roughly around 5 billion to healthcare budget. That's roughly around 1% of healthcare budget. 500 billion is normal annual healthcare budget of Sri Lanka. Apart from that, so yes, people might, they have unhealthy days and they recover, but that is not stopping there, right? At the end of the day now, we experience dengue and half of the workforce, they are not available. So that's mean that, okay, economic value activity is losing. So they calculate it and say, okay, because of our insurance covers help our customer base to recover faster from unhealthy situation to healthy situation, therefore they can come back faster to the economic activity, and what is the value activity we can create or we can contribute to the economy. So they contributed, they calculate and say that up to $58 million. So that means something is actively measured, and that agenda item is something very much interested from national perspective. And obviously, we can integrate this onto our business model because we are in the business of life and health. Same way, it's our responsibility to identify. One way is that to ensure that our business model is sustainable by placing the critical KPIs in such a way to ensure that value being created tomorrow and after tomorrow in sustainable manner. Apart from that, to address the sustainability impact, we need to identify relevant KPIs because end of the day, foreign investors, they cannot invest if we don't have these KPIs. And whether they, how much they like to us doesn't matter. And on the other hand, look at Sri Lanka, right? Our credit rating CCC. Who wants to invest the country having the credit rating of triple C? It's a big risk. So only this is the one way of access the capital. So obviously, they have a development funds, they have a KPI. So we can bypass this credit rating because of the sustainability KPIs. So that's all about for me.
Okay, Mr. Nuwan. So thank you very much. It's very encouraging to hear. And also, I think Mr. Nuwan's remarks, insights also weeded off a misconception that's commonly among us. What's that misconception? The misconception is that these sustainability disclosures are just decorations, not taken serious by any investors. But his very words, with evidence, indicates that there are certain even foreign investors would look at it very, very seriously. And there's a huge impact towards our entities in getting investment. I think Ms. Aruni also could take that very kind of very encouraging remark in educating as well as in kind of trying to provide certain insights to directors training to tell them that see that this kind of getting foreign investment and these kind of impact assessments are really important. So I think that evidence indicates it's very, very important. Thank you very much, Mr. Nuwan. So let's now move into my fraternity, the academic fraternity. She is Dr. Nuwan Gunaratna, one of the top 2% scientists in the world. We are very proud of him, hailing from the Department of Accounting, University of Sri Jayawardhanapura. So let me now pose him a question regarding the role or how actually the accounting education, particularly the management accounting education, should evolve. Because you yourself have some involvement in shaping the management accounting education. And of course, when we see the CMA trajectory, it takes very serious in developing its syllabus. So what do you think, how the management accounting profession should evolve in understanding this importance of sustainability as well as other dynamics?
Thank you, Mr. Chairman. So I'll try to give a short answer because I see the clock, it's ticking. Yes, to answer your question, I think we need to first look at what's really happening in the business world and how the business landscape has changed so that we know that sustainability is no longer optional. It's a financial and a strategic variable. So that earlier, the management accounting techniques focused on the linear models like budgeting, standard costing, or variance analysis, or financial analysis, or whatever it is. But now it's getting multidimensional. So that it's not only about reporting, it's about making this decision, making this sustainability information and embedding that into your decision making. As Ms. Darshini mentioned, it's about using this information in your budgeting, then again project planning, then again in pricing and so forth. So how to embed that information into your sustainability decision-making cycle. So in light of this, management accounting education, that is including professional education as well as university education, should change. So I see that three pathways, how this should change. Number one is that we shouldn't be teaching sustainability as isolated courses. They should be embedded in the curricula. They should be, because sustainability issues are no longer isolated issues. They are not management accounting issues. They are not financial reporting issues. They are strategy issues. They are governance issues. They are risk management issues. Therefore, in curricula, we need to embed sustainability accounting throughout these courses. And that's what we have done at the University of Sri Jayawardhanapura. We have separate courses on sustainability, but at the same time, we have embedded these courses into several modules to give that widespread knowledge to the students. So that the students should be able to see the trees as well as they should be able to see the forest. So that's the first pathway. The second pathway is that sustainability management education, management accounting education should be transdisciplinary, because the sustainability issues are getting, that you need to focus on climate science, energy management, then biodiversity management, which is going to be most likely the S3, then again climate change and the circular economy and so forth. so that the accountants need to have some knowledge. So it doesn't mean that the accountants should be climate scientists or engineers, but they should be able to translate these impacts into financial value and translate or to get these values into their decision making. So that the next pathway is that the professional education or management accounting education should be continually improving, or it has to be a continuous improvement cycle, because we know that sustainability challenges, the issues, the standards, the technologies, these are continuously changing. And if you look at what we have done 2 years down the line and what we are doing now, it has changed. How AI has changed our workflows, the way that we teach our students, the way that we evaluate our students, and even in your workplace, that you know how it has changed. Therefore, that sustainability management education has to continually evolve to embrace these challenges. And finally, Mr. Chairman, I would see that sustainable management education or management accounting education, it's not only about teaching students to report sustainability, but it is about teaching students to manage sustainability. Thank you.
Thank you very much. Very strong statement. So actually, as Dr. Nuwan says, that he explained that there are 3 initiatives. Particularly, the third initiative is particularly relevant to us as the main professional body, the Sri Lanka's professional body for involved and responsible for management accounting to take up. And indeed, that's what I have seen in our curricula, co-curricula, CMA curricula. We highlight that and we incorporate that, we embed that, and as well as we are looking at the future aspects. So that's a core competency that I see in CMA. So I really thank Professor Vatawala, the Vice President, Mr. Nayak Bandara, the Council, for taking that very seriously. So thank you, Dr. Nuwan, and indeed, your statement is very strong and we have to take it very serious because we need to produce professionals that are future ready. And as a professional body, CMA has taken that very seriously as well. Right, thank you very much. And now let's move into our next panelist, Mr. Nishantha Devavitarana, who represents the capital market. And so he is involved in research and particularly, so in capital markets representing a vice president, as well as he's also the head of the research. So Mr. Nishantha, now when we look at different initiatives taken by the capital market, the Colombo Stock Exchange. Now, apart from S1 and S2, implementation, what are the other initiatives taken? And what do you think the role of the CSC in propagating these sustainability disclosures? Because that indicates, as was told for foreign investors particularly, our solidarity, our commitment towards sustainability. So what's your take in that?
Thank you, Professor, for that question. I must particularly endorse what Nuwan mentioned about the use of sustainability information. Because foreign investors, of course, they do use, because we do conduct a foreign road shows to promote our listed companies among the foreign investors. Of course, they are very particular about this, and particularly they are institutional investors. Of course, their money comes with a condition. As he emphasized, of course, they should be invested only in ESG sound companies with sound ESG practices. Coming back to the question, in addition to S1 and S2, there are some other initiatives that are underway. In particular, in very high level terms, what the stock exchange can do in this area is, I would like to categorize into 3 different categories. One is, of course, the capacity building. And with the capacity building, of course, local investors or retail investors also would start using sustainability disclosures in their decision making. And not only investors, as Aruni mentioned, of course, for directors as well. Actually, we have conducted a couple of programs for directors. I think we should continue doing that because education is key. So the capacity building is one. The other one is, I would say, we can help companies increase visibility. Why visibility matters? Again, foreign investors, of course, if they are so keen, so interested, how can they come and pick such investment, such companies? Of course, that's why the visibility matters. As far as visibility is concerned, what can we do? Globally, the accepted, the best way of increasing visibility for companies is to rate companies. We know credit rating, AAA, AA, A, triple B, double B, and so on. Likewise, we can rate companies according to their ESG risk exposure. Remember, this is not based on the disclosure quality. The best disclosure, the company with the best disclosure may not get the best rating, is based on the risk exposure, how they are managing the risk. And coincidentally, we started the same project today. Letters would have gone to companies by now. This is going to be my first official announcement in that regard. So the beginning of next year, there would be ratings for companies. Coincidentally, that also goes with AAA, AA, A, triple B, and so on. So that the risk rating would be AAA, AA, and so on. So that is something that we started today actually. And of course, the rating exercise would start. It is not, by the way, done involuntarily, because this is done in consultation with company. In consultation, in the sense, this is predominantly based on publicly available information. And of course, there'll be some engagement with companies as well. I know if Colombo Stock Exchange does this rating, there would be 1,001 questions about the credibility, right? We don't have expertise. Actually, there is no reason for us to internally develop this expertise. And what the global practice is, of course, these are separate business. There are expert companies. And so that we are commissioning internationally accredited independent third party to decide or annually come up with ESG rating. Once the rating is done, of course, there is another step. It is nothing but take the best companies and compile a stock index, which we call ESG indices. So that once that we compile that index, which will be available from next January, of course, we would be able to see what the general price trend of such companies or ESG leaders. And so that's the, I would say, signature project initiative this year that we are doing in addition to the S1 and S2. And the other one is, of course, the third category is the product offering. And of course, we have already developed products like green bonds and sustainability bonds. And the framework is there. And there are some actual issuances as well. And most probably, mid of next year, there would be ETFs based on the index that I referred a while ago. And so that we do capacity building, and we do help companies increase visibility, and we do product offering for investors to come and invest in these kind of initiatives. So this is what we do in very high level terms, in addition to making S1, S2 mandatory.
Okay, that's very nice and very encouraging from a regulator's perspective. So yesterday, Dr. Sugit was asking, right, what kind of things you could get from this kind of a conference. So this is the very thing. He disclosed for the very first time that what next year that you will be having. A new index will be introduced, right, to assess the level of your sustainability encounters. So another reason why we should attend and why we should have these kind of conferences which has a great impact on the profession. And again, I really appreciate Professor Vatavella and the Vice President and the Council, Mr. Nayak Bandar and the Council for initiating and continuing these important initiatives. Okay, in the interest of time, in fact, I witnessed that we got the answers. In fact, we were looking at what's the current as well as what are the future now. The future also was unveiled. And we, in the discussion, it was embedded. So therefore, in the interest of the time, as well as already since we have deliberated that, we shall now shift into the questions. We have got 2 questions from the audience. We'll address that. So one of the questions, any panelist could take it up. So what are the key challenges of implementing energy management in Sri Lanka with regard to sustainable reporting? Regarding sustainable reporting, what are the key challenges in implementing energy management practices, sustainable practices, reporting practices? Any one?
In terms of energy management, I think the first thing is perhaps look at the GRI standards for energy and start tracking that information. Because first you have to achieve, to understand what your baseline is, what's your consumption pattern, what are the multiple sources of energy, how much do you consume, is there seasonal variation, does it vary with your production output, understand how energy interacts with your organization, and then see the pressure points. And once you have established a baseline, then you can set some strategies and see where you want to transition to. But the first step is to capture comprehensive, reliable data.
Thank you very much, Ms. Aruni. That's, I think, the capturing as well as setting up the framework. So setting up the framework will have an initial huge effort and a cost indeed, but we don't see that as a cost, we see it as an investment. So setting up the framework is the key. Thank you, Ms. Aruni. Really appreciated for your very great insights out of your long experience as a director and as well as a person who changed the trajectory in Sri Lanka regarding certain aspects. Then let me go to the next question. We have got 3 questions. So the second question is, how is the role of the board of directors towards the climate-related financial disclosure? So related to financial disclosure, so what the directors think or what kind of role they should play? Okay, Mr. Nuwan has taken the opportunity.
I think when it comes to sustainability, biggest responsibility lies with directors, right? So, and one thing, so they want to maximize the value. So value is all about current and future. So one is current, yes, obviously we can use whatever the metrics is, either profit or some other metrics we can have. But beyond that, director's responsibility is that money-making machine is well oiled and which is having the right shape. That is business model. So that is the biggest responsibility of directors. And to check that, directors' responsibility to identify right matrices or KPIs to ensure that check whether my machine is working properly, whether have I compromised anything, whether future risk, how that impact to my machine, and whether I have taken sufficient safeguards in risk management perspective to ensure that my machine is working properly to generate value for tomorrow and after tomorrow. That's all.
Perfect. Again,
May I add an example?
Yes, please.
So this is not with life, but general insurance. So for example, in California, it would be very difficult for you to get your home insured because of the risk of wildfires, right? So then if you can't get a home or a business or a building insured, would you move your business to such a place? So California, which is one of the richest states in the in the US and actually richer than a good number of countries. If you're not going to locate your businesses there, what's going to happen over the long term, right? So life insurance was well answered, but these decisions have really long-term impacts because an insurance is one of the first pins in the value chain to fall. If insurance falls, are you happy locating a business in that place? To me, that's a very simple question.
With the permission, with the 1 minute, let me give a classic example that very recently we launched because I don't know whether you are aware. So after 75 years, you cannot access the health insurance, right? So in Sri Lanka. So one of the thought process we had from the brainstorming session, why don't you give health insurance forever, indefinitely? That's the value proposition came. So then from directors and management, we have a responsibility to ensure that, okay, we are not taking undue risk or pricing, right? Because when you age, severity is very high, right? So then we brought a risk management framework. Yes, we will give health insurance forever, but it will be priced annually. So that's how we manage risks to ensure business model viability is protected while we capitalize in the opportunity. So risk and opportunity we handle both simultaneously while protecting our value stream. So that's a simple thing we did a few months ago.
Oh, that's very strategic. Balancing between risk and the opportunity. Because as accountants, we might be inclined to always look at risk something bad. But risk, there are different kinds of risk indeed, bad risk and good risks. But again, we have to look at risk also, right? Certain kind of risk, we can see what kind of opportunities that we could get. Particularly, that's what Mr. Nuwan was explaining as well as Ms. Aruni. Thank you very much for your insights. So we have further questions, but in the interest of time, we'll do the conclusion. So in conclusion, what we can see is, out of the deliberations, out of the very insightful introductory speech by Mr. Suresh as well as by Ms. Vatwal. So what we saw was, as well as the panelist deliberations, right? What we saw was that we have to understand that strategy, the sustainability reporting is not just a matter of reporting. It's part of the strategy of an organization. So it has to be embedded in that sense and should be taken by the top echelons of an organization seriously. So that's where the next point comes in, where the director should be trained. The director should be enlightened in this aspect. Unless the leaders get that message, and as Mr. Suresh told, that they are being shown the value, that's our responsibility, that sustainable reporting will be again just a compliance exercise. And that's where the third point comes in, where we have to educate and we have to enlighten the future generation through proper education, through proper grooming, not just theory, but practical insights. That's where Dr. Nuwan explained that particularly the role that could be played by professional bodies. And we are very happy to see that CMA has taken that very seriously. And even not only training our fraternity, the professional fraternity, I saw that giving 100 scholarships to government servants, which was a remarkable thing that I never had witnessed in the Sri Lankan history. So that kind of initiatives in education, in grooming the professionals, applies as well as the public servants and even the directors. Why not? In giving them the management accounting insights in their training programs, I can CMA could partner and have that strategic initiative getting forward, would be able to take our profession to the next step. And the final insight that we could get is the regulatory perspective, the regulations. So we saw Mr. Nishanta's insights are very important, where he told what's the role that regulators play. particularly bringing up indices as well as training awareness programs are really critical in driving this initiative forward. So those are the key insights that we could get out of this discussion, deliberation. So I would again really thank Professor Vatawala as well as the Vice President and the Council for organizing this very important session as well as the conference, and Dr. Sugit for coordinating meticulously and guiding and helping, assisting and doing all. And for all the participants who patiently waited despite the next step or the next move would be the lunch. So thank you very much for partaking as well as for listening as well as engaging. We got some very insightful questions. So really appreciated for your insights. Thank you, the chairperson, the keynote speaker, and my fellow panelists. Appreciated. The key thing is to take these insights and put that to action. Knowledge itself doesn't have power. Knowledge which action has power. With that final words, let me conclude the session. Thank you very much.
So indeed, as was emphasized, action is required. Now, we would like very much to invite Professor Vatawala, and maybe Mr. Kabir, as well as Dr. Sugit, to please come up on stage to do the usual handing over tokens of appreciation to all concerned. On stage, I mean. Yeah, start.
So we say thank you very much to our keynote speaker, Ms. Darshini Vatawala. Our panelists, Ms. Aruni Rajakarya, Mr. Nuan Vithanage, Dr. Nuan Gunaratna, Mr. Nishanta Heva Vithana, and of course our session chair, Mr. Suresh Gunaratna. And our moderator, Professor A.R. Ajwal. A group photograph is also in order.
So even as our photograph is being taken, we would like to again focus with appreciation on one of our partners at this conference. There are many who we will recognize as sponsors, but we'll focus on one to start off with, and that's our assessment partner. And we have a little message which we would like to share with you.
So our assessment partner, as you know, is Pearson Professional Assessments. And in your delegate bags, the purple ones that you'll see at your table on your chairs, you'll find an interesting new case study showcasing Pearson's partnership with CMA Sri Lanka and the successful transition to computer-based testing, which made exams more secure, scalable, and accessible for candidates everywhere. As a global leader in credentialing, Pearson delivers over 18 million exams a year worldwide on behalf of not just professional or academic bodies, but also regulators and certification organizations, helping millions earn internationally recognized qualifications. You'll see a video shortly on screen, and you'll understand more about Pearson's global impact on lifelong learning.
So have a look at that, please.
We are born to learn. From our very first breath, we never stop learning. It's our nature, our instinct to expand, to explore. Learning is more than just gaining knowledge. It's an action that starts a reaction, rippling through our lives, changing more than we realize. Proven to enrich our minds, enhance our health, revitalize our emotions, open doors, strengthen relationships, inspire purpose. Learning is vital to every aspect of our lives. To learn is to be truly alive.
More information to be found in the pouch or the bag that you have. And what matters now is to come back at 2 o'clock.
What you do between now and then, completely up to you.
By the way, a little reminder, in case you feel inclined and energetic, you can go downstairs to the level we were earlier and have a look at the motor cars. Stafford Motor Company have provided that opportunity for those who are members to benefit from a deal, and you can talk to the people there. The 2 Honda vehicles are also on display. All right, having said that, food is served and you're welcome to partake of it. You come back to your places, of course. I think it's over here and nowhere else.
Discover extreme power, pickup, and performance with 3P Tech. Servo 40, the science of extreme. Servo, world-class lubricants.
ක්‍රිකට් කියන්නේ පීඩනයක් තියෙන ක්‍රීඩාවක්. දිනුම තියෙන්නේ පීඩනයට මුහුණ දෙන විදිහ. අපි 96 ලෝක කුසලානේ දිනාගත්තෙත් එහෙමයි. දිගු කාලයක් ක්‍රීඩා කරන්න හොඳ ජවයක් අවශ්‍යයි වගේම වාහනයක එන්ජිමට හොඳ ජවයක් අවශ්‍යයි. මගේ තේරීම දිගු කල් ක්‍රියා කරන සර්වෝ ලුබ්‍රිකන්ට්ස්.
Servo Futura NXT. ඔබේ මෝටර් රථය සඳහා ඉහළ ක්‍රියාකාරීත්වයක් සහිත synthetic engine oil. Lanka IOC වෙතින්.
One of those days I just need to hit the road. Every turn, every time they calling out. One of those days I just need to hit the road and they calling out. Yeah.
Check. This is my temple. This is my mental peace sanctuary. The one thing I can't do without. You better hear me. Can't do without. I can't do without.
The ultimate biking experience is incomplete without Servo 40 Extra from Lanka IOC.
Breaking the wallow. Capsules a bitter pill to swallow. I can't start and wallow.
Servo 40 Extra from Lanka IOC. Can't do without it.
At DEMO, meaningful work goes beyond workplace achievements. It is defined by the impact we create around us. Throughout 2025, our efforts to build a resilient business and community while conserving our planet have thrived through volunteerism.
Sustainability at DEMO is structured in a manner where all employees at DEMO needs to engage and contribute. How this is through our Sustainability Agenda 2030, where we look at our business pillar, our social pillar, employees and community, and our environment pillar. Then at DEMO, we also have DEMO Nature Club, where the employees get an opportunity to volunteer to our conservation projects and for our community well-being.